All right. Hi, everyone. Thank you so much for joining me today for the DeFi Risks workshop. My name is Ashley. I'm really excited to go through this with you today. There's still a few people entering our waiting room, so I'm going to just give it another minute or two, and then we will get started. If you're joining us on live stream through YouTube, I'll try to toggle over and check periodically for questions as I stop throughout the presentation. If you've never been in a workshop with me, I really love it when people interact with me. I feel like we all learn better when people ask questions and when you share your own knowledge. So if at any point you have a question, especially if you're in the Zoom room, it's really easy for me to turn the mic over to you. But if you have any questions or comments, anything you'd like to share, please do so. This is not just a sage on the stage, me telling you all the things. It's great if we can collaborate together in this workshop. So please feel free to pop in or use one of the little emojis to raise your hand and let me know if you want to share anything. All right. I'm going to go ahead and get us rolling. DeFi risks, tips to avoid getting wrecked. So in this workshop, I will talk a little bit about just kind of a quick overview of how DeFi works. And then we'll talk about the different strategies and associated risks. DeFi kind of works like a puzzle. So there are different pieces that are required to make the DeFi world work. And each one of those pieces comes with different strategies and associated risks. So it's really difficult to explain it in a linear way because they all kind of feed into one another. So you'll hear me kind of weave in and out of the same topics throughout. But again, if you have any questions, please just give me a shout. All right. Then we'll go into risk mitigation. I'll tell you kind of what to look for as you're doing your research and starting to interact with some DeFi projects. So my name is Ashley Spradlin. I'm the Educations Programs Manager at Metis and at Crypto Chicks. I have a background in public education, nonprofit management, and state and local government. And my email address is down there at the bottom. So if you have any questions about our offerings at Crypto Chicks, or if you have an organization or a university club or your business that needs to learn a little bit more, we love to collaborate with organizations to bring blockchain and Web3 education. So definitely reach out to me. I'm happy to chat with you about that. So Crypto Chicks, if you are new to our organization, we're a nonprofit dedicated to bringing more women and youth into the blockchain space. While that's kind of our focus and mission, because there's definitely some disparity in the gender ratio in this industry, we're not exclusive in that we love to have anyone and everyone join our education and to talk with us about Web3. We have an online academy and hatchery, which is kind of an incubator to support Web3 startups. So we have chapters and communities in over 56 countries. We've helped over 30 startups get off the ground and develop their business plan and prepare to interact with investors. We have over 40 online courses that you can join our academy to get access to, and of course, a growing community. So again, our academy has on-demand courses. We offer live webinars like this one. And then we also have an educational podcast called Crypto Chicks Corner. They're just really short 10-minute episodes where we explain some of the basics. And then in the hatchery, we offer education and incubators support for startups. So a couple of different avenues to support you in your Web3 journey. One of our partners is Metis. Metis is a smart L2. So it's kind of like the evolution of an optimistic rollup, if you're familiar with that. Essentially, it's a scaling solution for the Ethereum blockchain network. So if you've ever used Ethereum, then you know that transaction costs can be kind of high, the speed can be kind of low, and that you can't like interact directly with the Ethereum blockchain. So the Metis offers this opportunity to scale in that people can build on the Ethereum network, they can build on Metis, and we can offer faster transactions, cheaper transactions. We, in fact, have the cheapest of any L2 fees, and it's very easy to deploy on our network. We're a decentralized platform for Web3 economies. So whether you're into DeFi or NFTs or community, if you have some idea for education or art or governance, Metis has all of the infrastructure that you need to get started. Just a little disclaimer that I offer in every workshop. None of the information in this is legal or financial advice. I'm not trying to sell you anything. I am not trying to tell you, I'm not an accountant or an attorney or a financial advisor. This is just me giving you information. So especially in this workshop where I talk a little bit about finance in general and kind of what to look out for in DeFi, please just know that this is a broad overview and not me telling you specific financial advice. I need to clean off my glasses here. So DeFi thrives on appealing to FOMO, your fear of missing out. This is how the whole world of DeFi kind of hooks people in. You'll see all kinds of tweets on crypto Twitter. Buy now or cry later. This token's going to the moon. It's the most undervalued project in crypto ever. All these juicy APY promises, and people think, okay, I'm here to make a quick buck, and they put a bunch of money in and they get wrecked. They lose it. So I'm going to teach you some things to make your what's called degen, is like when you invest in different cryptocurrencies. I'm going to teach you how to make sailing those waters a little bit smoother. So to start, let me just do a quick comparison for you. So in traditional finance, there's a stock market order book model. So if I wanted to buy a stock, let's say, then I would go on to something like Robinhood, which is a centralized exchange platform. And essentially, I have to wait for market conditions to be right. Basically, let's say I want to buy a pink token or a pink stock. And I'm willing to purchase this pink stock at $30. Well, now I have to wait for someone to sell it at $30. And, that may or may not happen. We may not be able to find the right market conditions to meet to facilitate that transaction. And now I also rely on an intermediary to facilitate this. So someone has to put this all together, has to run this market, regulate it, and they can bar access to financial tools. There's no real transparency in this model. And then the intermediary can potentially interfere with the market if they'd like to. So a really good example is the GameStop kind of stock crash that happened recently. And there's a whole documentary on it. If you've not seen it, I would recommend checking out. It's really interesting. But essentially, GameStop was shorted, which is a term that means that investors think that the price of it's going to go down. So they're essentially betting on the company to go under. And they put a lot of money into that. Well, what they didn't count on is that GameStop had this extremely engaged and supportive community that didn't want to see this business go under and didn't want to see these, big banks make a lot of money off of it. So essentially, they started buying GameStop, and the value of the stock price went really high. And the Robinhood app ended up restricting trading, and eventually were faced with a bunch of lawsuits because they interfered with the market. So this is just a good example of some ways that a controlled market can go awry. And so DeFi offers a space where we don't necessarily need to rely on an intermediary. And while there are options to place what's called like a limit order swap, where I say I'll only buy if it's $30, and then something, it doesn't sell until the price hits $30. That is an option in DeFi. For the most part, you don't have to like interact with another person. I don't have to wait for the right person to come along for me to do a trade. I'm interacting with a smart contract. So this is the cutting edge of DeFi, and smart contracts allow all this to happen on a blockchain, so it's transparent. Now, it doesn't necessarily mean it doesn't come with risks. And there are several pieces to the DeFi puzzle. There are all of these things that have to come into place for a DeFi ecosystem to exist. So first, we've got your wallet. You can't interact with a DeFi platform unless you have a wallet set up. And as we go through, I think in our DeFi 101 or our Intro to Cryptocurrency workshops, we explain more about wallets and how you can set one up. So if you need help with that, I highly recommend checking out some of our previous workshops that are a little more beginner friendly on how to set up your wallet. We also have smart contracts here, which are kind of like the base. So if you want to think about all of these things being the pieces of the DeFi puzzle, then smart contracts would be like the picture on the box that you look at to get it all together. Smart contracts are the foundation for this puzzle. And we've got a few different pieces here. We've got a DEX, which is the decentralized exchange platform. So this is the user interface that you go to do trades, to swap your cryptocurrencies, to buy crypto. Then we have liquidity, which means the money that is put into these pools that smart contracts govern to make sure that you can make your trades. They're called automated market makers. So essentially, cash money, not cash, but cryptocurrency, liquid crypto is put into a pool, and a smart contract will govern the transactions that happen with that pool. So that's the automated piece of DeFi. Whereas before in traditional finance, that would have been an intermediary like Robinhood who would do that. Oracles are necessary because they offer price feeds. They offer data. So oracles essentially gather information on the price of assets in like centralized exchanges, and they feed it to these decentralized exchanges. Now, oracles don't necessarily always have to report price. They can report data on just about anything from weather to sports to whatever. But for our DeFi puzzle, we're focusing mostly on price feeds. And then you have the options, the strategies that you can use once you have your crypto, which is borrowing and lending, farming, and staking. And all of these kind of come with their own risks. I've talked about some of these strategies in previous workshops, but I'm just going to kind of go through how these pieces fit together and what to look out for as you navigate this new world of decentralized finance. So there are some general risks involved across the board here. So I'm going to kind of go into each of these, and then we'll talk specifically about each piece of the puzzle and the unique risks involved with each aspect of DeFi. But generally, honestly, just about with any kind of Web3 project, there are some risks involved. And so I'm going to explain some of those here. The first would be smart contract bugs. So smart contracts, again, they're like a computer code if-then statement. They're conditional code that facilitates transactions. So basically, it's very easy to execute. If I've got a smart contract, if this person meets these conditions, then this automatically occurs. So that removes the need for a person to like facilitate these exchanges. They automate the transactions on a blockchain. In DeFi, they govern funds in a pool. So on an exchange, the way that people can make a trade without needing another person is that money already has to be there. The assets already have to be in a pool. So the smart contract governs how the funds enter and leave this pool. If the code of that smart contract has vulnerabilities in it, it can be exploited, and then the money that is in that pool can be drained. This has happened before. There are some examples of this that you've seen maybe on crypto Twitter or in the news. And essentially, unless you are a developer and you can read code, you have to trust that other people know what they're doing, which can be really scary, especially in a space where privacy and anonymity are held as the gold standard. So what you want to look for are projects that have been audited. And auditing is not a foolproof thing. It doesn't necessarily guarantee that there won't be a hack. There have been plenty of projects that have been audited and still have been exploited. The idea is to look for audits. Some projects will have multiple audits. That's great. If they're a credible project that has a solid track record, and by credible, I mean, are they brand new? Have they been in operation through more than one market cycle, like from a bear to a bull market? When things are really good, everybody's like talking about how great they are, but when the market starts to go down, are they still able to keep afloat? Are they still operational? Do they still have people using their platform? Are the team engaging with their community? Like, is it an accountable team? If people ask questions about something, are they getting answers? That's really important. If people feel like something fishy is going on and you get radio silence from the team, that's a red flag. I also want to mention that there is insurance that you can purchase for smart contract bugs. So if you've got your funds locked up in a platform, you can buy insurance that would protect you in case there was some sort of hack, and you'd get your funds reimbursed. It's important to note, though, that insurance is really expensive in DeFi. So it's probably, you just have to do a cost benefit analysis. If you're investing a whole lot of money, it might be worth it. So it's up to you to see, like, are your returns going to be worth more the cost of the insurance? Another hack that can happen here, or another risk, would be a scam or some sort of fraud, otherwise known as a rug pull. So essentially, a rug pull is when projects come on and they make big promises to people, and investors put a lot of money in, and then they disappear, they take the money, they run. Rug pull is often used in a lot of ways. Like, anytime something doesn't really meet expectations, it's a rug, is what people will call it. But what I'm really talking about are intentional rugs, where it's kind of the plan from the beginning. So if you look at this first headline here, this Squid Game cryptocurrency scam, essentially, like, I mean, it was in the documentation that you couldn't sell the tokens. They sold all of these crypto tokens, and people invested in this project, and it was clearly written that they wouldn't be able to sell them again. So they were just left with these tokens that weren't worth anything. The project developers just had the money, and then the token crashed and they weren't worth anything anymore. So it's really important that you read the documentation and that you ask questions. I don't advise anything, but try not to buy something just because everybody else is doing it. It's a good idea to look into the utility of a project. Are they adding value to the Web3 space? Do they really offer a product or a service that you understand? And there's another one here that says Anubis DAO investors lose $60 million in a rug pull. So this is another thing where people invested a lot of money and it was not returned to them in any way. So you want to look for audits, and it's important to remember that when you invest in cryptocurrencies, it's not like buying a stock. It's you don't have any assets that are backing your share of anything. You're not owning anything. You are purchasing something that has utility, or an asset that you think will change in value, but it's nothing tangible. So you really need to understand what the project is doing, what their aim is, what their roadmap looks like. Read their documentation, ask them questions, make sure that they, it's up to you if you want to decide whether or not you want to invest in projects where the team has shared their identity, they've doxed themselves. A lot of people will only invest in projects that do that because it seems pretty easy for people to just up and run if nobody knows who they are. But a lot of people really value the even playing field that the privacy and anonymity allows in Web3. So another way to kind of gauge that would be whether or not they're like actively talking with people and answering questions, and how long they've been doing what they're doing, and you know what their vision is. Again, insurance is an option. It's just up to you to decide if that cost is worth the risk. All right. Centralization, like a centralized control of a project, or a governance attack. So they're not really the same thing, but I put them together because they're both based on like a small group of people controlling a lot of what's going on. So centralized projects just mean one or a handful of people are controlling everything. If they can go in and change the way a smart contract is going to execute after it's already been launched, like that's a red flag. If they don't have any like clear procedures on how they would change processes, then those questions should be asked. Decentralized projects where multiple people on a team are working on something, where you have a multi-sig wallet, which means that several people have to sign off on a transaction in order to access funds in a shared wallet, in a treasury. Those things ensure that not just one or two or three people can take everything and run, or can mess something up. If you'll notice this first headline here, the Compound Finance fork loses money in an admin key hack. So essentially, someone who was responsible for the treasury wallet was careless with their key, was careless with their password information. And when someone else got it, they were able to take all the money. So one way to avoid that would be to have a multi-sig wallet where you would require multiple people to sign in to approve for transactions to access the treasury. Governance attacks. So a lot of DAOs operate with decentralized governance, which is part of the name. So essentially that means that if I own the tokens of a project, then holding those tokens gives me the right to vote in governance proposals. And that could be anything from treasury management to marketing to whatever. Now, in a lot of governance models, it varies, but in a lot of them, the more tokens you have, the more vested interest you're assumed to have in a project. And then the more voting power you have. Now, that assumption that just because you own a lot of the tokens means you're going to act within the best interest of a project is not always true. So the way that some projects get in trouble is people who own a lot of tokens will vote in a way that can hurt the project, or maybe they're uninformed, or sometimes people can just buy a lot of tokens and push through a proposal for the intention of like messing up a project, for attacking it. And because a lot of these governance proposals and the systems of the DAO are governed by smart contracts, that autonomous piece, unless there's like a time lock on how long after a governance proposal passes until something is executed, it can be difficult or impossible even for a project's team to catch that there's a governance attack happening and then be able to intervene before anyone loses money. So this is something to be mindful of, understand like how decisions are made, what kinds of things are up for vote, who's involved in making those decisions, and who has access to the treasury. And then market volatility. This is a big risk in that it's impossible to time. You know, right now, everyone says we're in this bear market and prices are low and sentiment is down, and people are thinking, okay, it's time to buy, it's time to do this, it's time to do that. But ultimately, you should recognize that it's impossible to time a market. You don't know what's going to happen. Things happen out of nowhere. Stable coins, which were once stabled, might tumble and depeg and go to zero. Something that you think is never going to drop below a certain price might crash way below it. something that you think will never moon might. So it's really difficult to time what could happen in the market. And if you are staking or farming or anything where you're receiving rewards in return for offering your funds to a platform, you have to keep in mind that the rewards you're receiving are often in that platform's token. So the value of that token determines like the return on your investment. So it's important to keep that in mind when you start to invest and you're thinking, okay, I'm going to get 1,000% APY return on my deposit here. But who knows how long that will last? And what if that 1,000% of what, so it's important to keep your eye on what the value of those tokens are as you move through. What the value of those assets can change. Dollar cost averaging is a strategy that a lot of people use. And essentially what that means is instead of trying to time the market when I'm going to buy and at what price, people will just buy small amounts on a consistent basis. So that way, yeah, maybe sometimes you do buy at the top and maybe sometimes you end up selling at the bottom, but over time, if you buy around the same time, the same amount with some consistency, then it'll end up averaging out. All right, so I'm going to pause here before I go into the different platforms and just see if anybody has any questions so far or anything that they want to share. If you're in the Zoom, raise your hand, ask a question, any of those things. And I will check out on the YouTube really quickly and just see if there's anything. Okay, I don't see any questions, but if any come up, let me know. I'm just noticing that my background didn't stay and you guys can see this messy room behind me. So apologies for that. Okay, well, we're going to go back to the presentation then, unless anyone has any other questions. All right. Sorry, my window has disappeared. There it is. Okay, apologies. Thank you. All right, so decentralized exchange. This is the platform, the peer-to-peer marketplace where you can trade, swap your tokens, or you can just like buy and hold. These are the two strategies on most DEXs. So as you're going into the decentralized exchange, there are some things you should know. The pros are with a decentralized exchange, you're going to hold your wallets and your own assets. So you're responsible for managing your keys, keeping your assets safe. You're also going to be interacting with smart contracts to perform these transactions, which means you're not waiting on an intermediary to intervene or to facilitate anything. It's also secure, transparent, and decentralized. It's usually cheaper as well. With these intermediaries in traditional kind of exchanges, there are often fees associated with managing your assets. And that's, while there are fees associated with trades, they're much, much smaller and they're redistributed to the users, to the individual people who are providing funds to the platform. So instead of them being held by, a handful of people or a large company, it's everyone who gets a piece of that. The cons are you already have to have some crypto to use them. So you already kind of have to know how to do a fiat on-ramp in a centralized exchange, which requires you to identify yourself so that you can exchange your fiat currency or US or Canadian dollars for crypto. And then you can go onto a DEX. They're unregulated. So this is great in that in that a lot can happen, that there are a lot of opportunities, and it makes it really easy for people to interact with these platforms. It's negative in that it's the Wild West. So that's all changing because there have been a lot of risks involved and a lot of people have lost money. There have been some scams or, you know, the unthinkable where a stable coin crashes and people lose a lot of money. So regulation is coming, and honestly, it can be something that's welcomed. We can work with regulation to make sure that this is a safe space, but also that the principles of decentralization are still held true. So some of the risks of using an exchange are, again, that market volatility. Since you're going to use an exchange to buy or trade cryptocurrency, if the value of an asset falls below your purchase price, you've just lost some money. So being able to understand the value of an asset is key. Insufficient liquidity. So again, when you exchange or trade on a decentralized exchange, money is, you're interacting with a pool of funds. And if there's not enough funds in that pool, then you may not have access to do a trade that you want to do. You may not be able to make a buy or a sell if there's not enough liquidity. We're going to talk about liquidity pools a little bit in the workshop. So we'll get there. Price impact, insolvency, and impermanent loss are all risks of insufficient liquidity or market volatility. I'm going to talk about those more in detail here in just a moment. Market manipulation is another risk of decentralized exchanges. So essentially, there are bots that will exploit gaps in price changes. So oracles, which I'll talk about more in a minute, they can create this opportunity for what's called arbitrage. Essentially, if I notice that on one exchange, the price of pink tokens is $5, but over here on this exchange, the price is somehow at $4.90. So what am I going to do? I'm going to go buy as many pink tokens from the exchange where the price is still at $4.90, and then I'm going to go sell them at the other one where the price is $5. And so it's called arbitrage, and there are bots that are automatically looking for these differences that will execute these trades like really quickly. And so that can kind of manipulate the price of these assets. It can also drain pools. MEV, it's just maximum extractable value attacks. Essentially in a blockchain, the way it works is when validators are like verifying, validating their network, transactions occur and they wait in this mempool, this pool of this like limbo place before they're added to the blockchain. And the way these validators are getting their money for their work to secure the network is from the transaction fees. And typically they'll want to choose the transactions in the mempool to put in a block that have the highest fees because that gives them the highest rewards. And so sometimes there will be some communication between traders and these validators to choose certain transactions to pass through to a blockchain so that they can get the most rewards from it. And so that can kind of impact the gas fees and the price of the assets that are there for regular traders. There are other kinds of attacks like this. So essentially, you just want to look for platforms that offer clear support and explanation of these risks on their platform. I know that SushiSwap, for example, they have what's called Sushi Guard. So when you interact on their platform, you can click the little Sushi Guard switch, and it will tell you like that they're protecting against bots. So there's some sort of like internal communication between the transaction validators and the traders themselves. So it kind of minimizes that risk. So just look for some clear explanation and support from those, but it is a risk in an exchange. Oracles are another piece of the DeFi puzzle. So decentralized exchanges get the prices of their tokens from centralized exchanges. So oracles are kind of like the facilitator of that. They take real-time on-chain data and they aggregate it and feed it to these exchanges. So essentially they give any updates on market changes and prices, but they can really provide data on anything. For this example, the price of the asset is the most important for a DEX. So can you see the opportunity here for there to be some sort of exploitation? If an oracle is a little slow, if the price feeds are delayed, there's an opportunity for arbitrage. So if the market has changed dramatically, like really quickly or in an unexpected way, and the Oracle hasn't caught up and relayed that information quickly enough, then if the market takes a sudden dip and on the DEX, it's still sold at a higher price, then people are going to buy a whole lot externally and then sell it on the DEX. And then vice versa. Let's say if the price on the market soars, but you're still selling it for cheaper on your DEX, then the opportunity for arbitrage is there. There are other more like technical aspects of oracles that are vulnerable to attack, but this is probably the most common one. I would say that if you're using a DeFi protocol, it's interesting to look and see like what oracle they use. Chainlink is the one that's most commonly used. They're considered kind of the gold standard of oracles in the DeFi space. Liquidity is money. So now we're going to talk a little bit about liquidity pools and what it means for a platform to have enough assets to facilitate trades. So your liquidity is like the assets that are available to interact with in a pool. Liquidity pools are governed by smart contracts. And usually in a liquidity pool, there are two assets. So you pair two assets together, and typically they are at what's called a constant value formula. So basically, if I've got, and I'll show you more on the next slide about this, but if I've got two tokens, then I need to have the same value of each in the pool at all times. So when I provide liquidity to a pool, I have to provide the same amount of two different assets to a pool. And then I earn rewards from transactions from that pool based off of like whatever percentage I put into it. So liquidity providing is a way to earn rewards on certain platforms. I'm going to offer money to this pool so that people can use it for exchanges, and then I'll get a percentage of rewards based off of the size of my contribution related to the overall pool amount. So let's say that there's a lot of liquidity in this pool. A lot of people have put money in. There's been a lot of money in there. Then that's really good for traders because there's less risk of there being insufficient liquidity for them to be able to interact with it. For liquidity providers, however, that's not as great of an advantage because the fewer people who are providing to this pool, the more share my contribution represents of the overall pie. So the more rewards I'm going to receive. But the more people that come in, the more secure this platform is, the more secure this pool is, but the less rewards I'm going to get because my contribution represents less of the overall pool. Price impact. So price impact essentially refers to that constant value thing, which I'm about to explain, and impermanent loss. So liquidity pools are there to serve as automated market makers. In centralized finance, the market maker is the platform where intermediaries connect a buyer and a seller and they facilitate a trade. Since we have smart contracts, we need these pools. So insufficient liquidity, like I've just explained, can be an issue. But price impact is when there's not enough liquidity in the pool. And so anytime someone buys one asset, the price of the other changes dramatically. So think about it like water. If I'm in a bathtub and I'm splashing around, a whole lot more of water is going to get displaced versus me swimming in a lake and splashing around. The more liquidity that is available in the pool, the less my splashing around, the less transaction is going to make waves. So the smaller the waves my transaction will make. That's what I meant to say. So basically, let's say I've got 500 pink tokens at $5 each in a liquidity pool. So that would be 100 pink tokens. And then I need to have $500 of white tokens because remember, the price of the two has to be the same. The value needs to be the same of each asset. But my white tokens are only $1 each. So I'm going to have 500 white tokens in the pool. So 600 tokens total, but the total value is matched. Now, every time somebody buys white tokens, the price of the white tokens is going to go up because there are less in the pool, there are more scarce, and we want to maintain this constant value of 50-50 here. So if the price of my white tokens goes up, that means the price of my pink tokens has to go down. Now, this doesn't have anything to do with the price of the assets on the external market. This is just what they cost on this platform and this pool. So if there's not a lot of each in the pool, then I'm going to buy some white tokens, and it's going to have a huge impact on the price because now there are a lot fewer less of the total amount. And so the price of them is going to go up quite a bit, and the price of my pink tokens is going to go down quite a bit because I've got to maintain that equal value that I started with. So this is kind of like a very basic explanation of price impact. And there are different kinds of pools that kind of weight this, but a 50-50 value ratio is like the common constant pool setup. So you want to look for pools that have a lot of liquidity in them. That way, if people interact with the pool, their transactions are going to make smaller waves. They're going to have less impact on the price. Now, in permanent loss, remember when I told you that these transactions impact the price, but only within the pool. It only changes the price of the assets on the exchange platform, right? So I'm only worried about what's going to happen here on this platform. In permanent loss is when I decide, okay, I'm going to withdraw the liquidity that I've added to this pool. Now, the price on the external market, though, has changed dramatically. So if it changes in either direction, then what's happened here in the pool may impact like what I'm actually able to withdraw. So basically, usually liquidity pairs are a stable coin where the value is going to remain relatively stable, and another token. If the value of one changes dramatically versus the other, then people are going to interact with the pool differently based off of the supply and demand. So as the value changes on the external market, what's left in my pool is probably going to change because people are going to be looking for these arbitrage opportunities. And if I withdraw during one of those price gaps, then I'm likely to realize what's called impermanent loss, meaning that the value of what I put in may not necessarily be what I'm able to withdraw because my share doesn't represent the same share now that it did when I first deposited my tokens. This is a little bit of a complex topic. Essentially, there are online calculators that you can use. If you just search for an impermanent loss calculator, you can put in some of these figures and it'll tell you what impermanent loss you're likely to sustain if you withdraw your tokens. Now, it's only impermanent because you don't realize the loss unless you withdraw during this price gap of what the price is here versus what's going on in the external market. If you're able to hold out and that is able to rebalance, then you can recover that loss. Now, borrowing and lending is kind of a new thing in DeFi, which is really interesting, particularly because in centralized finance or traditional finance, there's such a chokehold on financial services like loans. Credit score is a huge part of it, and your outstanding debt, your income, in some places like your criminal record, if you have one, lots of different things go into whether or not you have access to a financial tool like a loan from a bank. In cryptocurrency, we don't have that. You essentially put up collateral, you're able to borrow cryptocurrency and then pay it back with interest. If you don't pay it back with interest, you lose your collateral. Now, the key here, the barrier for a lot of people is that because cryptocurrencies are often backed by other cryptocurrencies, you have to over collateralize your loan, which means you have to put in like twice the amount of than what you're trying to borrow for one, because what if the value of the coin that you've put in for collateral changes a lot? And then now all of a sudden, what you've put up for collateral is worth less than what you've borrowed, you're going to lose that. You're going to get liquidated there. So having an understanding of the value of your collateral versus the value of what you're borrowing is very important. If you're lending then you need to understand like what collateral people are putting up for loans. If it's backed by cryptocurrency, if it's being backed by a stable coin, what kind of stable coin? What is that stable coin backed by? So stable coins can be backed by fiat dollars that are actually held in reserve. For every $1 there's one stable coin. It's a 1-to-1 exchange. But sometimes they're backed by other assets like gold or oil or other cryptocurrencies. So the value of those can also depeg. And so it's just really important to understand the value of the assets that you're borrowing or lending using as collateral and what is backing those assets. People will often use a strategy where they try to gain leverage. So they'll borrow on one platform, then they'll lend on another to earn interest, and that gives them leverage. Doing this too much for one particular asset can create this pressure to sell and then impact the price of the asset. So keeping an eye on what the trend of the asset is doing is important if that's your play. Okay, I want to pause again and just see what questions, if any, there are before I kind of wrap this thing up here. So I'm going to go on to YouTube. Nothing. I don't see anything here. Okay, just a little bit more. Essentially, tips for some due diligence. It's really important that you communicate with projects. Read their documentation, look through their docs, read their roadmap. If you don't understand something, ask questions. Look for audited projects, stay engaged with their news, and be focused more on like growing wealth over time and these like long-term strategies rather than the instant gains. And it's not to say that profit can't be made there. It's just that's definitely going to have more risk involved. So determine your risk aversion and go forward from there. Thank you so much for joining the DeFi Risk Workshop. I know that I explained a lot of kind of complex topics. I hope that it was clear. Casey, thank you so much for your comment. I know that the DeFi puzzle can be really complex. Everything kind of fits together in a unique way. So to understand one thing, you almost need to understand another. So if that wasn't clear enough, check out the podcast that I've put out on DeFi risks and one on liquidity pools and impermanent loss. I'll also share some videos soon that kind of explain some of these topics, and I'm always happy to answer questions. So reach out to us on social media, on YouTube, on Twitter, and you saw my email address earlier in the video. I'd be happy to clear things up. And the more questions you ask, the more I understand how to clearly explain things. So thank you so much for your participation and for your willingness to engage in your own learning. I also want to give a shout out to Women of Crypto. They've been really great in supporting us and being able to offer this free education. So just thank them so much for what they do and for their continued support. I'm going to go ahead and sharing my screen and just check one more time. Hi, Lee, do you have a question?
Yes. Hey, how's everybody?
I'm doing well. Yes. How are you?
It's all good. I have actually two questions. Number one, kind of related to DeFi. In a heartbeat, we would transfer our mortgage if we would find a lender in the DeFi space. So I'll let that, I know you don't have to answer me right now, but if you keep that in the back of my mind, in your mind, and let me know if you know of anybody giving out mortgages. And secondly, I do want to build
I've looked
on
for that actually. Sorry, go ahead.
You looked into it?
I haven't found any yet. I know that there are like real estate endeavors where people are selling like fractionalized, like they're minting a property as an NFT and then selling fractions of it so people can invest in a piece of it. But I've not seen any like crypto-based mortgages yet. If anyone in our community has heard of that, please reach out and let us know, because I've asked a lot of people and nobody's told me about one yet. I've been able to find.
Okay.
So, yeah, let me know if you hear of one, and tell us.
Okay, great. Thank you. My second question is, I'd like to start developing on meaties. Where do I start with that?
Oh, great. Okay. So we have a docs page like for devs. If you go to the website, then at the top it should say like docs. And that gives you like a breakdown of how to deploy. If the code is like Solidity, if we're an EVM equivalent platform, then it should be pretty simple. But you can also jump into our Discord or Telegram groups, and we have developer support moderators in those community groups that are really helpful in like showing you where everything is.
Thank you. Thank you so much.
Sorry, I think my internet connection was a little bad there for a second. So I hope that all of that came through. Lee, thank you so much.
Yes, I'm
okay.
back. I'm back. I heard everything. Thank you so much.
Okay, great. I think, yeah, my connection was a little weird for a moment. So I'm glad you heard that. But yeah, reach out if you have any questions on that. Anybody else? I could figure out the millions of tabs that I have open on my screen right now. I'll go to our YouTube and see if there are any questions on there. Otherwise, thank you everyone so much for joining. I don't think we have any more questions, so we can wrap it up a couple minutes early, I suppose. So thank you very much. And I will look forward to chatting with you all soon. Thanks. Bye, everybody.